Okay, hi everyone. I'm James Hart and welcome to this Orbex Trader Education session where we're going to be looking at the top technical indicators on the MT4 platform. Now, many new traders begin their Forex journey with technical indicators. I suppose the idea of using a tool to help you time market entries and catch powerful reversals is an attractive one. However, with so many indicators out there, it can be difficult, quite daunting even for new traders, learning which ones to use and how to use them. So in this session, we're going to take a look at the top technical indicators to help you get started with your trading. And for those of you who have already been trading for a while, hopefully this will serve as a nice reminder of the indicators that you should be focusing on. So first of all then, what are technical indicators? So indicators are simply tools built into the MT4 platform that measure price based on different variables to give information on how price is behaving. And they're typically looking at aspects such as volatility, momentum, and trend direction. Now, indicators can be used to simply act as a guide for analyzing the charts, or they can actually be used to provide specific entry signals. Okay, so you can either use them to help form a bias on the market and then look to take trades based on whatever setups it is that you rely on usually, or you can actually use the indicators themselves to provide specific entry points. So we're going to look through a few indicators here today. I'll introduce the indicators to you. We'll talk a little bit about what it is they're telling us about the movement of price, and then we'll look specifically at how we can trade them. We'll look at some on an individual basis, and then we'll also look at some that you can combine. So if you have any questions during the session, please just type them in the chat function, and as ever, I'll stop periodically as we go along. But for now, let's jump straight in and look at our first indicator, which is going to be the RSI indicator. So the relative strength index then, which you can see here, and this is a screenshot of the sub panel of an MT4 chart. So the RSI indicator then, a classic Forex indicator used to measure momentum in the market. So the indicator measures the strength of recent gains against the size of recent losses with a view to identifying price as being either overbought or oversold. And this can be a brilliant tool for helping traders identify periods when price is vulnerable to a reversal. And so for this matter, it works particularly well in range-bound markets, but it also works well when you're looking to time corrections during trends. So you can see the indicator here, this blue oscillating line, has an upper threshold, which is the overbought threshold, signaling that the market is vulnerable to a reversal lower. And then we have the lower threshold, the oversold threshold, indicating when price is vulnerable to a reversal higher. And these are set up as defaults on the MT4 platform at 30 and 70, but you can, of course, customize them to make them more or less sensitive. Okay, so let's take a look at the RSI indicator in action then. Okay, so here we've got an example then on euro dollar, and this gives a really great example of how the RSI indicator can help traders time the market. So you can see here that price is trending higher. We're putting in a series of higher highs and higher lows, and the indicator is also rising higher as price does, indicating that momentum is strong in the market. So bullish momentum is strong, buyers are in control, price is rising, all is well. However, you can see at this point here, where I've highlighted the little square on the chart, the indicator actually runs into overbought territory. So you can see the blue oscillating line has moved from all the way down near oversold territory here. Price is traded higher, momentum is strong in the market, the indicator has moved higher, and at this point here, we've actually crossed the overbought threshold, indicating that momentum is overstretched to the top side and price is vulnerable to a reversal lower. And then you can see from this point here that we did in fact get a reversal lower as the indicator moved away from the overbought threshold. So just this very basic example then should hopefully highlight to you just how effective and useful the RSI indicator can be in helping us identify periods where price is vulnerable to a reversal. Okay, and so the typical trading method that we see traders using around this information is looking to fade the RSI indicator. So that's where we look to sell as the indicator registers an overbought reading, like it has here, and then we look to buy as the indicator registers an oversold reading, like we've seen here. So it's a very simple, very straightforward way of using this indicator, but as you can see, it can be incredibly effective for helping us time the market and catch these reversals. Now, another way to use the indicator is to use divergence. So if we pull up a fresh example here, and I'll walk you through what we're seeing on the chart. So divergence is essentially referring to a situation where the movement we're seeing in price is not supported by the indicator. So in this example, you can see that price is rising strongly higher. We've had this really sharp, explosive move to the top side, and then we've seen price putting in this typical bullish trend higher. However, you'll notice, and I've shown this with the pink lines, although price is continuing to trend higher at this point on the chart, the indicator is beginning to move lower. So we've crossed above that overbought threshold, and you can see that although price is continuing to put in higher highs, the indicator is putting in lower highs. So once we see this situation developing, we know that bullish momentum is waning in the market and that price is vulnerable to a reversal lower, okay? Because the indicator is telling us that the moves in price are not supported. So although price is continuing to move higher, the indicator is suggesting that buyers are actually losing momentum and that selling momentum is starting to build. And so you can see then that once we break down through that rising trend line, we've got confirmation of our reversal and price trades lower. So divergence then is a little bit more of a strategic way to use the indicator. It's slightly more advanced, but again, it's just a very simple process of tracking the indicator, tracking the moves in price, and then asking yourself, do they line up? Is the indicator confirming the moves we're seeing in price, or is it suggesting that the moves are likely to fail? So where we've got a bullish trend like this, we can be on the lookout for bearish divergence for a sell position. And then if we're in a bearish trend, we can be on the lookout for bullish divergence for a buying opportunity. So again, a really simple, really straightforward indicator and really simple, straightforward ways of using it. But hopefully, as you can see, these can be incredibly effective methods for helping you catch turning points in the market. So that's the RSI indicator then. And as I say, it's a momentum indicator where we're looking to identify price as either overbought or oversold. And the great thing is, RB asks, does it work on any time frame? It does work on any time frame. So it makes it incredibly useful for traders, whether you're looking at the higher time frames, taking longer term swing positions, or whether you're looking to scalp intraday on the shorter term time frame. So it does work on all time frames. And the next indicator we're going to look at then is the stochastics indicator. So we're sticking with the momentum indicators. And the stochastics, just like the RSI, measures momentum in the market and seeks entry points at periods where momentum is overstretched and price is vulnerable to a reversal. So the indicator measures the relationship between price and the high and low over a range over a certain look back period, and then is identifying momentum as either overbought or oversold. And you can see, just like the RSI indicator, it has an upper threshold signaling that momentum is overbought and vulnerable to a reversal lower, and it has a lower threshold signaling that momentum is oversold and vulnerable to a reversal higher. So just like the RSI, this is a bound oscillator. And again, we've got default settings here of 80 and 20, but you can customize these yourselves on the MT4 platform. So as I say, the stochastics indicator then can be used in the same way as the RSI indicator. So we can use it to highlight periods where momentum is overstretched and we can trade a reversal, or we can use it to highlight divergence in the market, periods where the indicator is suggesting to us that a move in price is running out of steam and price is likely to reverse. Now, what's really great about this indicator is that you can see that we actually have two oscillating lines this time. So we don't just have one line like we saw with the RSI indicator. And these two lines can be extremely useful in helping us time our entry points to the market. So essentially, the red line represents the longer term measurement, and which is the 5-period look back, while the blue line represents the shorter term, faster measurement, which is the 3-period. And again, you can adjust these yourselves so they're more or less sensitive to price, but these are the default settings. Now, one of the best ways to use these two lines then is to wait for both lines to cross through a threshold, and then wait for the red line, which is the longer term line, wait for the blue line, which is the shorter term line, to cross back through the slower line. So let me pull up an example then, and I can explain to you this in a little more detail. So looking at this example then, you can see that price is moving higher. We're putting in that classic bullish trend setup with higher highs, higher lows, higher highs, higher lows. And you can see that the indicator is trending higher also. Now at this point here, you can see that the indicator crosses above the overbought threshold. However, what we don't want to do is we don't want to look to sell yet, okay? So what we're looking to do is wait for the blue line to cross back down below the red line. So we're waiting for the shorter term line, the faster term look back, to cross through the slower one, the longer term look back. And what this actually does is help us to get a more specific pinpoint entry for the reversal. And what it is really fantastic at doing is keeping us out of trouble when the market is trending. So you can see here that price is moving higher. We cross above the overbought threshold at this point here. However, we don't look to sell until the blue line crosses back below the red. So if we'd sold here at this point, you can see that price actually continues to move higher, trades all the way on up to this point here, and it isn't until this point here that the indicator rather gives us that crossover. Okay, so you can see that the first crossover we get is the blue crossing below the red here at this point. So this can be your first sell entry. It's a slightly more aggressive way to trade the indicator, but you'll find through looking at the indicator that the crossover of these lines does tend to give good results, and it can be very specific in helping us time the reversals. Or alternatively, you can wait for both lines to cross back down below the threshold at this point. So what I'm trying to show you here is the benefit of waiting for the lines to cross over as opposed to just trading the indicator when it crosses the overbought threshold. But again, as with the RSI indicator, really fantastic indicator for helping us identify periods when momentum is vulnerable to a reversal lower, when the market is overstretched in either direction. Okay, so the next indicator we're going to look at then is one of my personal favorites and also one of the most effective ones, and this is the MACD indicator, which is the moving average convergence divergence indicator. And that's a bit of a mouthful. I know it sounds like some sort of nutty 80s invention, but it's actually a really useful technical indicator that can be incredibly effective for helping you get information on both trend direction and timing entry for the market. So the indicator then measures the difference between a longer term and shorter term moving average to identify price as either bullish or bearish. Now, when the histogram is above the center line, so you can see the indicator here in the sub panel, when the histogram is above the center line, this means that the market is bullish and expected to rise. And when the histogram is below the center line, this means that the market is bearish and expected to fall. Now, as well as being a great reference point for direction, the actual crossing of the center line can be used by traders as a signal to enter the market. So when the histogram changes from negative to positive, this is a buy signal, and when the histogram switches from positive to negative, this can be a sell signal. Now, the indicator also measures momentum, and this is shown by the size of the bars in the histogram. So the larger the bars in the histogram, the bigger the moves we're seeing in the market, the more momentum is in the market. However, unlike the RSI and Stochastics indicator, the indicator isn't what's called a bound oscillator because there's no upper or lower limit. So it isn't identifying momentum as either overbought or oversold. It's simply showing you where momentum is increasing or decreasing. And then the main focus is on trend direction, for which it can be particularly effective. So let's take a look then at an example of the MACD indicator in play, and I'll walk you through what we're seeing. Okay, so if you take a look at this image then, you can see immediately just how great the MAC tool can be for highlighting the direction of the trend in the market and then also for helping us identify the best points for entry. So the vertical lines that I've drawn in on here then highlight the 4 points over this period where the MACD indicator switched from either bullish to bearish, as shown by the histogram crossing above or below the horizontal center line. So to begin with, you can see that the first signal gives us this big sell-off here all the way down to this point before price reverses higher and starts a bullish trend. You can see that the MACD crosses positive here, so we get a buy entry here. Price then trades all the way up to this point here, so we get a massive bullish move. You can see the histogram stays positive the whole time before we actually top out at this point, start to reverse lower. And then we see the indicator crossing negative, so we get a sell signal, and then you can see price starts this big bearish move all the way down to this point here, before then once again turning higher, trading up, giving us a bullish signal here. Price continues higher all the way up to this point before topping out again and reversing. And for those of you who are in the price patterns, you can see we've got a little triple top setup here. So price tops out at this point, reverses lower, and then we get our bearish signal. So just from a really basic standpoint, you can see that this can be a really fantastic tool for helping us gain information about the direction of the market, but also in helping us time entry points for the reversals. So without looking at any other information and just looking at the signals and the directional guide the indicator gives, you can clearly see just how well it indicates the direction of price, as well as highlighting key turning points that you can use to make trading decisions. So the great thing about this indicator then is just how versatile it is. So you can use this indicator simply as a directional cue. So for example, let's say you're a breakout trader looking to buy as price breaks above highs, or sell as price breaks below lows. You can use the MACD indicator as a guide to help you get a sense of which direction you should be looking to trade. So if you pull up a chart like this and you see that the histogram is positive, you know that the market is bullish and you should be looking to trade breakouts to the top side. Alternatively, if you pull up a chart and the histogram is negative, as it is in this period, then you know that you should be looking to trade to the downside as price is in a bearish trend. So it can be a really fantastic directional cue like that for helping you to get a hold on which direction you should be looking to trade. But similarly, it can also be a really fantastic tool for gaining entry to the market, so for timing entry to the market. So as you can see on the chart then, the areas where the MACD histogram crosses either bullish or bearish actually give us specific entry points to the market. Now the great thing about this is this can be a really stress-free, easy way of helping you trade the market. So many traders struggle with actually timing entry points to the market. So essentially what we're looking at is for the indicator to cross from bullish to bearish to give us a sell signal, or from bearish to bullish to give a buy signal. So when the indicator changes from below the center line to above the center line, that's a buy signal like we're seeing here. And then if we're seeing the histogram cross from above the center line to below the center line, that's a sell signal like we're seeing here. And then what you can simply do is keep an eye on the size of the bars as you manage your trade, because what they're telling you is the strength of the market, the strength of the momentum rather in the market. So as the bars are getting bigger, this means that the market is expanding and momentum is increasing either to the upside or the downside, because it means that the difference between the shorter and longer term moving average is getting bigger. Or alternatively, if the bars are contracting, getting smaller, that means that momentum is contracting because the difference between the averages is narrowing. So once you've entered a trade, you can keep an eye on the bars, because you know that if the bars are starting to get smaller, then there is a potential shift coming. However, again, you don't need to change your position until the actual histogram itself moves either above or below the center line. However, there is one thing that you need to bear in mind if you're trading this indicator from signal to signal. So for example, if you're looking to sell when the indicator gives a bearish signal and buy when the indicator gives a bullish signal, there are going to be lots of times, as you can see here, when you enter a sell trade, the market expands sharply, you've got a really good amount of profit on the table. However, as you can see here, if you're waiting to exit at the point that the indicator gives a counter signal, then there are lots of times when the price simply reverses and then you end up giving back most of your profit. So that is one of the common complaints that people have with the MACD indicator, is that if you're trading it signal to signal, so e.g. just waiting to buy, sell, buy, sell, then there are plenty of times when the market gives back a certain portion of the profit. But one way that you can counter this is simply by being a bit more mechanical with how you manage your trade. So instead of looking to hold the position until a counter signal develops, you can simply look to target a fixed level. So for example, looking to target 2 or 3 times risk. So from the point you enter, you determine your stop loss value, either to be a fixed value or based on holding it behind certain candles, so such as having a 2 candle stop from entry. And then once you've established your stop, you simply look to target 2 or 3 times your risk. So you start to systemize your trading a bit more. And instead of just trading from signal to signal, you're actually playing for specific targets. So this is something that you'll need to do some testing with yourself, because this really depends on your own personal trading style. Because there will be times when you end up missing out on bigger moves, but then there will be plenty of times, like we see in this period here, where you end up banking a good level of profit before the market reverses. So it really comes down to your style of trading and whether you're looking to take smaller trades more frequently or looking to hold trades for a much longer period. Okay, so the final way that you can use this indicator then is to trade the crossing of the signal line and the MACD. So the signal line is this red line here, and it's essentially a 9-period moving average of the average between the two moving averages. Okay, so it all sounds quite complicated, but you don't need to worry about it so much. What we're basically focusing on is looking to trade when the MACD crosses above the signal line and when the MACD crosses below the signal line. So if you look at what we're seeing in the market here, so the MACD moves above the center line, giving us a bullish reading. What we then want to do is wait for it to drop below the signal line and then cross back above it. And these can be used as buy entries. So when the histogram is above the center line, we know that the market is bullish. We're then looking for the MACD histogram to drop back below the signal line and then cross back above it to give us a buy entry. Similarly, when the histogram is negative, so when it's below the center line, what we're looking to do is wait for the histogram to pop back above the signal line and then drop back down below it, giving us a sell entry. So this can be a really fantastic way for traders to time the market, and this should probably appeal to the more conservative traders among you, because you're actually waiting for an extra filter with your trade. So instead of just trading when the histogram itself crosses bullish or bearish, you're waiting for this extra confirmation with the MACD and the signal line. So there are more elements involved, but it can help you gain really good entry points to the market if that interests you. Okay, so the final indicator we're going to look at then is the Parabolic SAR Indicator, so the Parabolic Stop and Reverse Indicator. Pardon me, I'll just have a sip of water. Okay, so this indicator then can be really, really useful as well. It's slightly different to the other indicators that we've seen, but it is another momentum indicator, essentially highlighting where price would have to move to confirm a reversal. So for example, where the dots are above price, this means that price is in a bearish trend and price would have to close above that dot to confirm a bullish reversal. Similarly, where the dots are below price, this means that price is in a bullish trend and price would have to close below one of those dots to signal a bearish reversal. So the indicator is essentially telling us the point that price would need to move to confirm a reversal. And this can be a really fantastic tool for helping us capture reversals in the market, but it can also be an extremely effective trade management tool for helping traders find areas to trail their stops. So once you're in a trade, so if you're in a bullish trade, you need to keep price trailing up below these lower dots, and if you're in a bearish trade, you need to keep price trailing down below these above these upper dots. So it can be a really effective tool, not just for gaining entry to the market, but also for helping us manage our trades. So let's put a look at the chart then and explain this in more detail. Okay, so looking at this region here then where price is moving to the top side, you can see we've got these dots moving up below it. So this is telling us that this is where the market would need to come to affect a bearish reversal. So price would have to close below one of those lower dots in order for a bearish reversal to be confirmed. So you can see at this point here, price is trading higher. So we've got our bullish trend in play. We move up to this point, and then at this point here, we close down below that last lower dot. Dot switches to the top side, so we know that a bearish reversal has taken place, and then price starts selling off. So as I say, you can use these dots as actual entry points to the market. So once price is closed below that lower dot and the dots have shifted to the top side, we know that the trend has potentially changed, and this gives us the go ahead to enter a short trade and then wait for price to continue trading lower until such a point that the dots switch over. So if we'd entered our short trade at this point here, we'd simply hold on to our trade until we see the dots change to the downside, because we know there's the likelihood of a reversal in play. So it can be a really simple, really straightforward way of identifying reversals in the market, and a really fantastic tool for helping you trail your stops, because, as I'm saying, the dots tell you where price needs to go to confirm a reversal. So if we're in our short trade and price is moving lower and we're looking to keep our trade open, all we need to do is keep trailing our stop above these upper dots, because until one of these dots is broken and the dots shift, there's no need for us to close out our position. So it's a really fantastic tool for helping traders enter at reversal points, but also for helping traders manage their trades, because from the traders that I speak to on a daily basis, this is one of the issues that many traders have, is helping them stay in winning trades. So we're always looking to bank a minimum of 2 to 3 times risk. However, there are traders that like to hold on for trades for a longer period, especially trend followers. And so one of the issues they have is looking for a sensible way to stay in the market. And this indicator is one of the best indicators for helping you do that. So looking to trail your stops above and below these dots can be a really fantastic way of helping you keep trades open and helping you stay in the market to get the most out of your position. So we've looked at a few really fantastic indicators so far. What we've done is we've looked at the indicators individually, using indicators on a standalone basis. And when you're trading these indicators like this, it can be a really simple, powerful way to approach the market. As you've seen, the indicators are really straightforward in terms of how they display information about price. And once you've learned to understand what the indicators are telling you, they can be really effective in helping you make trading decisions. However, you don't just need to trade the indicators on a standalone basis. You can also combine them to create trading strategies with more filters. So 2 indicators which work particularly well for this, and that we'll look at in this example, is the Stochastics Indicator and the MACD Indicator. So we know that the MACD Indicator can be a really great tool for helping us identify trend direction. And we know that the Stochastics Indicator can be a really great tool for highlighting periods of overstretched momentum. So how can we use these 2 technical indicators together to make better trading decisions? So the best way to do this then is to use the MACD indicator to highlight the trend. So we're looking at the indicator to give us a directional bias, which direction we should be trading in. And then we're using the Stochastics Indicator to actually time our entries. Okay, so think about it like this. If the MACD indicator, if the histogram is above the center line and bullish, then we want to be looking to buy, but we want to wait for periods where the market is correcting within the bullish trend and momentum becomes oversold, because we know that this means there is a potential higher reversal coming. Similarly, if the MACD is below the center line and bearish, then we want to look to sell, but we want to wait for periods when the market corrects against the trend and momentum becomes overbought, because we know from that a reversal lower is likely. Okay, so that sounds a little complicated, don't worry. We're going to look at an example now and I'll talk you through this situation. Okay, so when we pull up our chart and we load on our Stochastics Indicator and our MACD Indicator, the first thing we want to do is establish our trend direction. So we want to look at the MACD Indicator and ask, is the histogram above the center line or below the center line? because this is going to give us our directional bias. So if we look at this point here, I've put the red horizontal line in. This highlights where the histogram has gone down below the center line, meaning that the market is in a bearish trend. So once we've highlighted that the MACD is in the bearish trend, we then want to look for periods where the market corrects higher against itself and momentum becomes overbought, because as we know, this signals that a reversal lower is likely to happen. So if we track the stochastics indicator then from the point at which the MACD indicator flips bearish, and what we're looking for is periods where price corrects higher and the indicator moves into overbought territory. And you can see that there are two clear examples of this in the chart. So the MACD indicator is bearish here because the histogram has fallen lower. And then at this point here, we get our first correction. So price moves higher like this, we're correcting higher within this bearish trend. The stochastics indicator moves into overbought territory, telling us that the momentum has become overstretched to the top side and a reversal lower is likely to happen. So at the point that we see that happen, we can go ahead and enter our short trade. And again, remember, we either wait for that blue line to cross below the red, or we wait for both lines to cross back down below the overbought threshold. And then similarly, we can keep tracking price, and we see that as it develops, we get another correction higher here. Price moves higher. The indicator suggests that momentum is overbought again. So we've crossed above that overbought threshold. And then once again, we're looking to enter either as the blue line crosses down below the red, or as both lines cross down below that overbought threshold. So this is a really, really great strategy that you can use. And the brilliant thing about it is how methodical it is. And it's just a straightforward process that you're following. So you pull up the two indicators, you're looking at the MACD indicator. Is the histogram bullish or bearish? This tells you in which direction you're looking to trade. Excuse me. And then you're looking to the stochastics indicator to keep you, to make sure that you're getting in at the right point. So to identify these periods of overbought or oversold correction. And the great thing about waiting for these double filters is it will help you to keep you on the right side of the market, so you won't be looking to trade against the trend. And then also it should help you keep to be able to protect your risk during periods of chop and range bound markets, because you're looking for the two indicators to line up in conjunction with one another. You typically won't get too many confluent signals in periods where the trend isn't moving, which is obviously what you want for a system such as this. So it really is straightforward. Like I'm saying, all you need to do is follow the two indicators together and then look to stay on the right side of the market. So where the MACD is bearish, you're looking to wait for momentum to correct to the top side and become overbought, and then you're looking to sell. And if the MACD is bullish, you're looking for the stochastics to register periods of oversold momentum where you can then look to buy. Okay, so this is how you can combine these two really fantastic indicators to help get a better view on the market and to help you find periods where you can actually go on to enter. Okay, so everyone, I hope you've enjoyed today's session. Thanks a lot for joining me. Thanks for your questions. It's been a really interesting session, and I hope you've enjoyed looking at these different indicators and getting a sense of the different ways that you can trade them. And as I say, whether you're looking to trade them on a standalone basis or in conjunction with one another, the key thing to do is just to make sure that you're following a really straightforward, processical way of looking at them. So whether you're looking to identify momentum as overstretched or overbought, or you're looking for the MACD to help you identify trend direction, once you spent some time tracking indicators and tracking price, you should develop a really consistent way of being able to trade these indicators. And the key thing is to not be looking to trade every signal that the indicators give, but look to build an understanding of the way that the indicators track the movements in price, and look to find the conditions where the indicators perform best, and that's where you look to take advantage of them. And then where the price conditions aren't favorable for the indicators, then you don't need to be in the market. You can simply stay out and wait for favorable conditions to arise. And yet the indicators are instrument independent, so you can trade these indicators on all instruments on the MT4 platform, and you can look at them on all time frames. So whether you're day trading on the short-term charts or taking bigger positions on the higher time frames, the indicators are just as effective on each chart. Okay, so thanks a lot, everyone. Take care with your trading and look forward to catching up with you all next time. Thanks a lot. Bye.